Assalamu alaikum. Today we will discuss the topic which is asset market uncertainty. First of all, we want to know what is asset. An asset is anything valuable that you own or control which can help you earn money, save money, or provide some future benefits. Now, what is financial asset and what is consumer asset? Financial asset are assets that derive their value from contractual claim. For example, stock, bonds, bank deposit which is a financial asset, and we cannot get utility by consuming this asset because this is a asset we cannot consume directly. And then consumption asset are assets that are tangible assets, that are tangible, we can touch this type of asset and we can use directly this type of asset or consumed. For example, house, we can live in a house. We can use jewelry, so we can get direct utility from this type of asset. Here we see example: stock is a financial asset that gives us dividends or capital gains. House is a consumption asset that provides shelter, and it may appreciate its value over time. We have already talked financial asset versus consumption asset. Now in this slide we can more clear about this. Here financial asset provide higher return but no direct consumption value, and consumption assets provide both enjoyment, which is utility, and potential return. For example, stock, financial asset, gives only return. We cannot directly use this, or uh, we cannot get utility from this. House, consumption asset, which provide us uh, living or shelter plus return, which is value appreciation over time. We know that over time an asset can increase their value. So the key difference is financial assets are mainly for oil creation, while consumption assets give personal use plus potential financial gain. Here we see return on consumption asset. Consumption assets provide both directly utility asset and financial return, which is appreciation value. So the total return will be consumption benefit T plus appreciation A. So here we see and the formula return equal to T plus A divided by P. Here T consumption benefit, which is rental value or uses benefit, plus A appreciation, which is increase the value of this asset over time, divided by P, which is purchase by price of this asset. So if you consider a house, we can get rental value or uses utility, which is T plus price appreciation A. So we will get the return of the consumption assets. Now we want to discuss rates of return under certainty. Under certainty, all risk-free asset must provide the same rate of return. If this rule violate, then it can create arbitrage opportunity, which we will discuss our next slides. So here formula 1 plus R equal P1 by P naught, where R rate of return, P naught initial price or investment, and P1 final value or price. So here we see example: if one bank offer higher interest than another, people will move their deposit to that bank until interest rate balance out or equalized. Here we see arbitrage opportunity, which is very interesting. Here arbitrage, what is arbitrage opportunity? Arbitrage opportunity is buying an asset at lower price in one market and selling it at a higher price in another market. So if we can get arbitrage opportunity, then we can earn risk-free profit, or profit. We can earn profit without taking any risk. So here we see formula, uh, P1 equals P not equal P1 divided by 1 plus R. So here P not today's price, P1 future price, and R risk-free rate of return. So here we see an example of arbitrage opportunity, which is if gold is cheaper in Dhaka but more expensive in Chattogram, an investor can buy in Dhaka and sell in Chattogram, making a profit without any risk, which is very interesting. Finally, we want to see differences among assets. Asset can differ uh, based on their liquidity, risk, tax treatment, and consumption benefits. Here we see some example. Uh, Treasury bill, which is liquid, so it fall under liquidity asset. House can give shelter, and which is less liquid. If we want to sell a house, then we have to take some time to sell this. Then government bond have low risk, and also it consider uh, high liquid asset. And finally, we see stock, which is which is a high risky asset, and also it provide high return. And tax treatment, some asset may be taxable and other may be tax free. That's all in today's video. We will continue this topic by a couple of video if you like this. Thank you for watching. Please like this video and subscribe my channel.